In just 72 hours, Bitcoin plunged from over $91,000, crashed below $87,000, and then violently rocketed back up to set new highs. Trust me, this was not random.
What we just witnessed was a precision liquidity hunt, a targeted takedown of leveraged positions with over $100 million in capital at stake, and it all just vanished in a few hours.
So you gotta ask yourself, how did a catastrophic drop like that become the actual fuel for an even more aggressive rally? Well, the data shows this entire V-shaped recovery wasn't just predictable, it was basically engineered. Let's break it down.
To really get what happened, we have to rewind a little. We need to look at the market structure right before the chaos hit. On the surface, things look stable, but underneath, a dangerous amount of leverage was building up, all on one side of the boat.
Okay, so on November 28th, the price was just chopping sideways, right? Pretty boring. But then, as we rolled into the 29th, leveraged longs started piling in, creating these really dense pockets of stop losses. And by the end of the day, a massive pool of liquidity had formed just below the market, right at that big psychological number, $90,000.
And this heat map from the 29th just lays it all out perfectly. You see these bright yellow and green bands right there at 90,000? That is a huge cluster of leveraged long liquidations. That's not just a support level, folks. That's a target. It's a pool of money just waiting for the big players to come hunt it.
And with a target that obvious on the map, the hunt began. The move that followed wasn't just some market panic. It was a deliberate, calculated pushdown to trigger those exact liquidation levels we just saw.
And what's so powerful is looking at the before and after. On the left, you see that thick wall of money at 90K. On the right, after the cascade, it's just gone, completely wiped off the map. This forced selling created a chain reaction, pushing the price down even harder. If you find this kind of visual breakdown valuable, do us a favor and drop a like and share.
So here's the crucial pivot. After all those longs got wiped out, the market sentiment did a complete 180. Everyone saw that giant red candle and thought, okay, the trend is down now. So they started shorting. And in doing so, they created a brand new trap.
This heat map from December 2nd shows you exactly how that new trap was set. See, after the crash, the bears got cocky. You can see this new wall of liquidity forming. But look, this time it's above the price. This bright yellow band right around $90,000 represents a massive cluster of short liquidations. It's the fuel for the next leg up. For more timely updates like this, you should follow us on Twitter at Snippet Labs.
And boom, here's the second squeeze. On the left, you see that wall of shorts, just waiting. On the right, you see price just punching straight through it. All that momentum from liquidating the longs on the way down was basically stored up and then unleashed to liquidate the shorts on the way back up.
And that's the absolute core of what happened here. The big squeeze down wasn't the end of the move, it was the beginning. It was the necessary first step to build up enough energy to trigger an even bigger squeeze on the other side of the market. And hey, if you want to see these kinds of data-driven analyses first, you should probably subscribe to the YouTube channel.
So after this violent two-sided purge, where does that leave us? Well, the market has essentially been reset. It's cleared out all the weak hands on both sides, and it's found a new, temporary balance.
And just look where we are now. As of December 4th, the price is sitting pretty at $92,380. That's not just a recovery. That's a new high. It's higher than where this whole cascade even started. The market took the elevator down and a rocket ship back up.
Looking at the current heat map, you can see the board is already resetting for the next round. We can see new liquidity zones forming. Notice this dense cluster building up near 91.5 on the long side. And there's a growing band of short liquidations just above 94,000. These are the next battlegrounds. And if you find these visual breakdowns valuable, go ahead, drop a like and share this explainer. So what's the strategy here? What are the big takeaways? First, the market is actively hunting and punishing one-sided leverage. It's just what it does. Second, whenever everybody seems to agree on a direction, that consensus becomes the target. Third, these dense liquidation zones, the bright yellow spots, they're basically magnets for price. And finally, remember that these small structural events can absolutely steamroll any bigger, broader story that's going on.
To put it all in one sentence, the market hunted the longs, used that momentum to hunt the shorts, and the result was a perfect V-shaped recovery that actually left the market stronger than it was before.
Which leaves us with a final thought. The board's been wiped clean, leverage has been reset, so the game starts all over again. The question isn't if another hunt will happen, it's which side of the book will get greedy first and build up enough liquidity to become the next inevitable target. If you want to keep up with this, make sure to subscribe and follow us on Twitter at Snippet Labs for real-time updates. Thanks for watching.